Welcome back to episode 3 of the series, How to Start Trading Stocks as a Beginner. If you haven't already seen the previous episodes, you can go to the links in the caption and check them out. It takes a lot of knowledge, research, discipline, and patience to become a profitable stock trader, not something you can learn or do overnight, which is why this series is perfect to help you get started on your journey. Now, there are a couple of things that you need to clear about before we continue the series. The first thing, like I said, is not to expect to start earning from your investments and stock trading overnight. Sure, you want to be the next person to win big with a lucky stock trade, and there's nothing wrong with wanting to. But the thing is, you have to be realistic and give it time. The entire process is part of a cycle, and it needs ample time to mature. And what's important is that you use the time in between to learn about what it entails so that you can understand what's going on and make better informed decisions if you want to be a profitable stock trader. Ironically, the best way to get rich, according to experts, is slowly. Randy Frederick, the Vice President of Trading and Derivatives at Charles Schwab, said, quote, "Investing is not about getting rich quick. Investing is about getting rich slowly," unquote. Warren Buffett is one of the richest in the world, and although he started investing at the age of 11 and continues to be at the top of his game at the age of 92, he earned 99.7% of his wealth after the age of 52. When Jeff Bezos, the founder of Amazon, asked him why his style of investing is so simple, yet no one copies him, Buffett replied that nobody wants to get rich slowly. In other words, more the number of years, the better, as compounding begins to show its power with time. Understand the business, its story, and future potential. Only then, invest your hard-earned money. Think of it this way. If you are unfit and want to strengthen your body, you start exercising. But many people give up because after they've gone to the gym for a few weeks expecting great results, when they don't get what they've envisioned, they quit, right? But what if you forget about the results and focus on just being healthy and continue working out consistently for an entire year without doing anything extreme? Just small steps every single day. The results will compound, and you will be surprised as to how far you have reached after a year. The same applies to investing. If you have a long-term mindset and are ready to accept the risks and persevere, no one can stop you from being successful. That brings me to my second point, the difference between investing and trading, and why this series is going to help you in the short term. Trading and investing both involve seeking profit in the stock market, but they pursue that goal in different ways. Investing is very simple, and almost anyone with no prior knowledge of the stock market can start right away. Investors buy stocks and hold them for many years, but traders hold them for minutes sometimes, an hour, a day, a week, or a few months, with the aim of short-term profits. Traders often focus on stocks' technical factors rather than a company's long-term prospects, and what matters to them is the direction the stock will move in next, and how they can profit from that move. As a trader, you can literally often take advantage of small mispricings in the market, such as when political uncertainty in a foreign country temporarily pushes down the share price of an American manufacturer, or depending on whatever country you're in. But just because trading is more fast-paced and seemingly simpler than investing doesn't mean you jump in on a whim whenever you want. It needs brain work, a little more skill than investing, and time. Yes, time and commitment. Why? Because analyzing the charts and patterns of a share is a key element of it. Also, the knowledge of indicators and technical analysis in general is important for a trader. Plus, if you're looking to make money on the stock market, you must dedicate a certain amount of time to acquiring those skills. Got it? Okay, let's move on to the next part. The two main types of stock trading: active and passive trading. Active trading is a highly technical approach that you take when you're aiming to capitalize on short-term price fluctuations. Active traders are generally further divided into two major types based on the time period in which they hold their securities. Day trading, which refers to any strategy that involves buying and selling stocks over a single day, such as seconds, minutes, or hours. Swing trading, which involves buying securities and holding them for days or weeks. Passive trading focuses on stocks' long-term trends, rather than short-term fluctuations or market news. Passive traders buy stocks based on overall market trends and sell when they believe the security hits its peak, which can take months. Remember I said stock trading needs time? So passive traders generally trade less than active traders and are similar to long-term investors who follow a buy and hold strategy. It goes without saying that stock trading is a risky business. Yes, trading individual stocks can be exciting and profitable, but it's not easy. Like I said, successful trading takes time and commitment. So if you're just starting out in trading stocks, it's best to avoid day trading and consider longer-term strategies. In fact, Randy Frederick said that day trading is actually the worst option for beginner investors. So you might want to steer clear of that at first. Okay then, now that you're armed with the stock trading basics, you're good to go. But remember, Frederick says, dip your toe in, don't dive in. So the first thing is opening a trading account. It's a good idea to start by picking a broker to make trades. Opt for one that you like and trust, and based on their specialties. As you decide on a broker, choose one with the tools, features, and interface that best complement your trading style and know-how. Other things to keep in mind at this point are fee structures, on-the-go accessibility, stock analysis tools, and educational resources. Essentially, as a beginner traders, you'll be better off with a firm that has a wide offering and that will be there when times get tough. The next step is setting a trading budget for yourself and sticking to it. Our expert on the topic, Frederick, suggests that if you're feeling inclined to shiny new investments or companies, you should allocate only up to 1 or 2% of your investment budget toward those assets. Basically, you can start trading with just about any amount, but the key is not to touch the money you might need in the short term, like for mortgage payments or emergencies. Got it? Like I've been saying throughout the series, you gotta do your research. Don't fly blind just yet. Learn the basic types of stock analysis before you make your move. Trading mostly relies on technical analysis or making decisions based on stock price and historical market data, rather than fundamental analysis, which involves evaluating a company and determining its true worth. And that's where new traders usually stop short. The goal of technical analysis is to analyze price movements of a security in an attempt to forecast future price movements, while a technical analyst may look at statistical trends and patterns with a chart. A fundamental analyst will start with a company's financial statements. While both analysis styles seem to be opposite to each other, I suggest combining so that you have more comprehensive understanding of the markets, which of course will help you develop a better sense of where your investment is heading. Depending on the country you're in, and if you can access one, say, online, first try practicing stock trading without putting real money on the line with virtual trading or paper trading. Just so you know, virtual trading allows you to test your trading skills in a low-stakes environment to get the feel of it, minus massive risks. Okay, so regardless of whether you have practiced with a simulator, once you've funded your brokerage account, you're actually and technically ready to place your first trade. But you do need to plan going about it to maintain discipline and consistency as a trader. A good trading plan typically outlines entry or buying points and exit or selling points per your skill level, risk level, and your overall goals. Look, every position you hold will have its own technical parameters, so be mindful of the time and effort each of your stocks will need. Don't forget to build, watch, and manage your portfolio. It'll be easy if you're using a human advisor or robo-advisor, because they'll do all the heavy work for you by managing your portfolio for the long term and keeping you following the plan. But if you're managing your own portfolios, you'll have to make trading decisions yourself. You'll have to ask yourself questions like, is it time for me to sell a stock or fund? Was my investments last quarter a signal for me to sell or buy more? If the market dips, am I buying more or selling? These are tough questions for both new and old investors. If you're investing actively, you'll need to stay on top of the news to make the best decisions. But even if your investing style is passive, building your portfolio and managing it yourself can be a simple process, as long as you start with automation, which is convenient, can help you reach your goals, and can be part of a dollar cost averaging strategy. If you're in the US, a 401k or 401b plan is essentially automated through payroll deduction, but the accounts that you manage, such as a brokerage account or IRA, will require you to automate manually. As for building a portfolio, your risk tolerance and financial goals can direct your asset allocation, which is a mix of stocks, bonds, cash, or other assets, and the specific investment selection. Once your portfolio is established and you're set up with automation, the minimal requirement to manage it is to rebalance it periodically, like once a year. Phew, that's a lot, right? Think you can do it? Let's recap with some more tips that will minimize your risk. Create a plan that dictates when you'll buy and sell. Like, you could sell if a stock rises or falls a certain percentage. Stick to your plan. Very important even for experienced traders when certain stocks shift. Follow your strategy and don't let your emotions or overhyped stories get the best of you. Figure out how much money you can afford to lose, and don't trade more than that. Again, important. Go in with open eyes even if you have an advisor. The stock market's long-term average return is set to be 10%, and studies have shown that it's extremely difficult for even professional traders to beat the market. So don't give up, but keep an open mind and keep learning. Know your taxes. We didn't talk about this in the series, but you can't ignore them wherever you are in the world. You might be able to take a tax deduction for trading costs, but you might also owe taxes. Also, try to learn about short and long-term capital gains so you understand how things flow. The bottom line is that even though stock trading seems easier than investing, it isn't for the faint of heart. There's so much you need to learn and determine before you even get to make your first trade. The stock trading is a risky business where your money is always at stake. Success isn't guaranteed, but with patience, research, and luck, you'll be well positioned to take advantage of the substantial potential that stocks have to reward you financially throughout the years. Good luck.